Hello and welcome to another video on how to secure yourself financially. So I'm going to make a quick recap of this entire section, the beginner guide to financial statement, because I want to focus in today's video on read the footnotes, right? So in this section, the SEC, these Security Exchange Commissions, mention that if you're able to read nutritional labels or to read baseball box score or soccer box score, you can learn to read the basic part of financial statement. And if you can follow a recipe or apply for a loan, you can learn the basic of accounting. And the basic, there are difficult. There are rocket science. So in this section will give us basic understanding of how to read this financial statement, much like the CPR course teach you how to perform cardiopulmonary resuscitation, but it won't train you to be an cardiac doctor. So the same here in this section, because what we're gonna see here, or what I learned from this, is, hey, anytime we see a set of financial statements, we can make sense of them, which is the end goal of this. So after all, financial statements, they show you the money, period. And there are four types of financial statements. You have balance sheets that show what a company owns and what it owns at a fixed point in time. Income statement, how much money a company made and spent over a period of time. The cash flow, the exchange of money between the company and the outside world, as well as the statement of the shareholder that show the change in interest over time. So in this section, that just only focuses on the first three financial statements. The TLDR of the balance sheet is it is a snapshot of the company assets, liabilities, and shareholders' equity. Okay? Assets are anything that a company owns that has value, whether it's tangible or intangible. Liabilities, obligations that a company has to pay, for example, creditors or the vendors, or even customers. And the shareholders' equity, which is the hypothetically money, or the money that if the company decide to sell all of their assets and pay off all of liabilities, that money left over belongs to the shareholders. So this is generally, or this follow a formula called the assets equals liabilities plus shareholders equity. And generally you can find is display in that fashion, or all the assets listed at the top followed by the liabilities and the shareholders equity. So the first part of these assets, okay, the assets are generally listed based on how quickly they can be converted into cash. So you have current cash, asset that a company expects to convert that into cash within a year. So for example, inventory and non-current assets that will take longer than a year. So also we have something called fixed assets that allow your business to run. So there are items that are not for sale: equipment, property, plant. Liabilities, which are generally listed based on their due date. So you have current liabilities, obligations that a company have to pay within a year, and long-term liabilities. And the shareholders' equity show is the amount of money, something they describe here. Okay? The shareholders' equity is the amount owners invest in the company stocks plus or minus revenue or losses since inception. Okay, so sometimes companies redistribute earnings instead of retain them, and they call this dividend. So the next is the income statement, where the bottom line of this statement show if a company made a profit or not. And you can think of this statement as a set of stairs that you start from the bottom, you start from the top, and then each town, you start at the bottom, that you start at the top, and once you go down each step, you make a deduction associated with earning that revenue. And at the bottom of the stair, you see if a company made a profit or not. So generally speaking, you start with the total amount of revenue, and once you go down one step at the stair, you make a deduction associated like merchandise or discount. Then you reach to the net income. Okay, the net revenue, and they call that net because much like a fish net, when you pull over that, all the things that are left in the net, that's why they call like that. So you have their net revenue, and then you generally deduct things like cost of sales, which is how much money a company spends to produce a good and service. Okay, you reach now to the, once you make that deduction from the net revenue, you reach at the gross profit. Okay, and they call gross because there's some deduction that hasn't been made from that. So this gross profit, once you go down the stair, you deduct now things like operating expense, so expense that a company incur for their day-to-day activities, like marketing, administrating salaries, developing or improving new prototypes. Once you deduct that, you now reach to the operating profits before interest and income taxes. So the interest here is, broadly speaking, money that a company borrow or loans that it takes. And the income statement, the income taxes is the amount of money that a company owns after the interest has been deducted from the operating profit. Okay, and then you know if a company, at the bottom of this income statement, you know if a company made a profit or not. Cool. And then I look at the cash flow, and it reports the company inflow and outflow of cash. And this is something important because company, much like people, need to have cash on hands to pay its expense or purchase assets. So this is generally reused, or it reused the information from the balance sheet and the income statement. And the bottom line of this statement show the net increase or decrease in cash over a period of time. And generally, this cash flow statement review the cash flow from one of these activities. You have operating, investing, and financing. So the operating, what it does is to look at the net income, okay, and conciliate with the total amount of cash that was used or perceived from operating activities. Meaning the most common operating activities are operating assets and operating liabilities. Where on the operating assets you have things like accounts receivable, inventory, prepay expense, so expense that a company incur for good or service that is going to be received in the future, such as premium insurance, like medical or like health for medical coverage, life in the event of the policyholder's death, liabilities like lawsuits, disability that prevent you from working, vehicle and home, as well as long-term, such as nurse home healthcare or home healthcare, nurse, nurse care or home healthcare, nurse healthcare or home healthcare. Okay, and blah blah blah. Uh, Keep looking at other prepaid expense are marketing, rent, software license, uh, as well as maintenance contract. Another intangible assets are, or another operating assets are intangible assets, such as patents, where now this is exclusive rights to the inventor, so they can manufacture, distribute, and sell that invention over time. And the patent that changed the world, okay, just to mention a couple one, from popular mechanics, you have is the maglev, this electromagnetic inductive stabilization system for ground vehicle that allow, for example, this high-speed trains in China, for example, issued in 1969. So you get the maglev, the electronic device, as their patent name called, aka the iPhone, issued in 2007. GPS, this as their patent name called, navigation system using satellites with passive ranging techniques, issued in 1974. CRISP, this gene editing tool, issued in 2014, or EMIT in 2014, as well as the 3G mobile communications. So there is a 3GGP. Okay? There's an organization or this partnership program. Okay, which is this 3GGP, which is an umbrella term for a number of standards organizations which develop protocols for mobile telecommunications. So they develop and maintain protocols like GSM, related to 2G, GSM, UMTS, this Universal Mobile Telecommunication System, or unrelated 3G standards, 4G or LLT, long-term evolution is 4G standards, the 5G the 5G standard. So why I brought this, because this is something very very important, especially if you want to know and if you want to mention what are the patterns that change the world according to popular mechanics. This is something interesting and something that you can brought up in a dinner talk or a lunch talk, you know, especially if you're in a business lunch or business dinner. This is something that can provide value to others. In any case, so copyright, which is another intangible asset, where now these are this image and designs that uniquely identify this competition from the rest. So, for example, the famous quote from Michael Buffer, "Let's get ready to rumble." Okay, that's trademarks. This is trademarks, A copyright, which are exclusive rights to creator of original work, so they can manufacture and distribute their invention over a period of time, such as Netflix, Spotify, Twitter. Goodwill, the brand recognition, reputations, and customer list. Customer relationship is another intangible assets. Keep looking at another operating assets like investing in affiliates, where you have things like joint ventures, a partnership between two or more companies to undertake a specific business activity, such as Crocs and Post Malone. Equity investment, where now a company purchases significant amount of stake in the another company. Stocks, raising it is gaining influence and potentially, so raising its voice and potentially influencing the another management uh, company decision, in the another company management decision. So Berkshire Hathaway, okay, like Berkshire Hathaway here, led by Warren Buffett, which is a multinational holding company that invests primarily in different sectors like energy, healthcare, as well as retail. SoftBank, which is a Japanese conglomerate that invests primarily in uh, industry like the technology industry, in the technology sectors such as WeWork, Uber, Airbnb, Alphabet, the Google's parent company that invests primarily in technology company through its venture capital arm called Google Ventures. Okay, as well as the Pacific Tech Group, which is a private equity Pacific. I mean, it's Texas Pacific, Texas Pacific Pacific Group. Okay, here, the Texas Pacific Group, where now this is a private equity that invests primarily in sectors like real estate, healthcare, and then also look at another common operating asset like cash and cash equivalents, such as money market funds, which now are funds. Let me look at this from Wikipedia. Are funds that involves or this market fund or this money markets involves the purchase and sale of large volume of very short-term debt instruments or financial instruments, such as bank acceptance, very short-term debt issued by banks, certificate of deposits, certificate of savings with short-term maturity, commercial paper, unsecured corporate debt, the repo, this repurchase agreement, which are very short-term government securities, and the treasury bill, or in this case the U.S. Treasury, short-term government debt. Okay, this is common examples on the U.S. from the US. Okay, and after all, most of the time, all of them and most companies are following the same principle. They are doing that. They are doing that, my friend. Okay, so then I look at the most common operating liabilities, where here you have things like accounts payable, money that you owe to your suppliers and vendors, usually between a 30 to 60 day for supplies or raw materials, office supplies, service, accrue expense, which are expenses that a company incur for good and service that has been received but not yet paid for, such as administrating salaries, rent, taxes, utility bills. Deferred revenue, which are obligations that a company has to provide for good and service in the future based on money that has been collected, such as subscription service, gift cards, short-term borrowing, which is another example of uh, operating liabilities or most common operating liabilities, uh, where the company has to pay that within a year or less. So bank loans from business as well, such as uh, financial institutions like venture capitalists or private equity, line of credits, trade credits, when you some companies renegotiate their repayment schedule to their providers and vendors, outstanding invoice. So companies can show their invoice to a lender, and based on the value of this, they're going to receive a borrowing or a loan. In this case, they're going to receive is a loan from them. A payroll advance. So when company now provide, uh, when company now provide is a credit basically to employers. In this case, is uh, advance in their payroll that will be deducted in the next pay day. I also look at the income taxes payable, where now this is money that a company owns to the government, such as corporate taxes, where in the US is something around 21%. So corporate debt, with withhold withstanding withhold withhold withholding tax. Okay, so this is money that the employer. Okay, so money that the employee deduct from the yeah money that the employer deduct from the employee's gross wage and pays directly to the government. This is to promote the pay as you earn tax system, uh, and to fight tax evasion, basically. So, sell taxes, which is another example of income tax payable, okay, such as states or local, even foreign taxes, as well as VAT, this value added tax, which is imposed on the production of good and service at every stage of the production of good and service, where the customer ultimately pays the full VAT for it. And business along the supply chain remit that portion to the tax. Excise tax, like particularly good or particularly tax imposed on certain goods, like guns, gasoline, tobacco, alcohol, and GST, which is a tax imposed on the VAT in places like Australia, Canada, and India. So then I look at notes payable, which is an agreement between the borrower and the lender to where the borrower outline all the terms and conditions of that loan. So when you ask a loan for a bank, you generate this notes payable. Outline is things like the principal, which is the amount, the original amount borrowed, the principal, or so the principal, the interest rate, as well as the repayment schedule. So business. So when a company want to raise funds from a financial institutions, venture capitalists, private equity, you they generate this notes payable, also for individual as well as the trade payables, but now for your suppliers and vendors. Okay, some suppliers and vendors actually uh, allow you to do that. Okay, installments loans. We're now here. Uh, it creates a notes payable for a if a company decides to purchase assets such as equipment or property. And then I also look at the warranty obligations, which are obligations that a company have to fix and replace a defective product or a product that doesn't meet certain quality standards, such as service warranty, manufacturer's warranty, parts warranty, vehicle warranty, uh, that kind of thing. So once I look at the most common operating activities, okay, and how the cash flow actually review or this first part of the cash flow, review the cash flow from the operating activities, and the way to do that is by first conciliate the net income conciliate the net income for the non-cash items that affect the items that affect the income statement without any cash involved, such as depreciation, amortization, as well as stock-based compensation, something that I'm going to talk about that later. Okay, and with these operating activities here, okay, with these operating activities, then so the way to do this is by uh, it adjusts the net income from the income statement with the total amount of cash of non-cash items and the total amount of cash that was used or perceived from other operating activities. And when it comes to the investing activities, generally involved is the purchase of long-term assets, such as property, plant, and equipment, investment, intangible assets, leasehold improvement, okay? And these long-term assets, so for example, if a company decides to, and it is funny that this is an investing activities, okay? It generally involves the purchase of these long-term assets. So let me take a look at here at these long-term assets. Example here. If we go up, okay, if we go up, you got it? Yeah, property, plant, and equipment, intangible assets, okay, so patent, trademark, copyright, brand name, license, software, investing, Okay, stocks, bonds, mutual funds, and long-term loans made to other entities. Goodwill, okay, which is brand recognition, reputation, customer loyalty. Long-term receivables, these are loans or amount owed to the company that have a longer repayment period, typically exceed on 1 year. Natural resources, okay, assets such as oil reserve, mineral deposit, timberland. What the hell? Timberland. What meaning? Forested land. Okay, especially land containing timber of commercial value. Okay. More at Warnick. For forested land. Forested land. Timberland. Timber. Timber. Well, what does it mean, timber? Trees or wood land considered as a source of wood. Timber. Wood used as a building material. Lumber. Timber. This is British. Merriam-Webster. Oh, okay. Yeah, I get it. Timber. Growing tree or their wood to frame, cover, or support with timbers. Timbers. Okay, wood sustainable for building or for carpentry. Yeah, this is a British. Timber. Holy, oh my god, so timberlake mean is forested land that can be used for timber? Oh my god. Okay. Timberland. Forested land. Okay. Timberland. But this is very, very British. Timberland. Natural resource. Assets such as oil reserves, mineral deposit, timberlands, or water rights that are used in the company's operations. Leasehold improvement. Yeah, something that I mentioned. The leasehold improvement is improvement made to a lease property, such as a lease, such as renovations, alterations, additions to better suit in company needs, deferred change, deferred charge. These are costs that are initially recorded as assets but are gradually recognized as expense over time. Examples include prepaid expense and deferred financing costs. It is important to note that the specific long-term asset held by a company can vary depending on its industry. But again, just to mention this, most common long-term assets, whether it's property, plant, and equipment, intangible assets, investment, yeah, goodwill, okay, yeah, goodwill, natural resources. This is more like for the government perspective or even for yourself. So natural resources, oil reserve, minerals, deposit, timberland, or water rights. So natural resources, leasehold improvement. Okay. Uh, so all of these are example of these long-term assets that falls in the investing activities. The second part of the cash flow statement. Okay. And then I look at the third part of the cash flow statement. So if I look, for example, Yahoo, and we analyze the Apple for that, okay, like here, the cash flow statement, okay. Like this, right? So the third part of the cash flow statement, which is the financing cash flow, it involves the company long-term liabilities and equity ownership. So generally involved is the uh, or this, according to Investopedia, this section focuses on how a company raises funds and paid back to creditors or investors through capital markets. So this generally review is uh, how a company is raising funds from capital from investors or creditors, repaying debt, and distribute earnings. The most common example of these financing activities are issuing equity in the form of stocks. For example, when a company wants to go public in an initial offering, an initial public offering, an IPO, that's what it is. Okay, the IPO, issuing equity, issuing debt. So a company wants to raise funds by issuing some debt financial instrument like bonds, notes payable, debentures, debentures. Okay, it's a certified or voucher acknowledging a debt. Okay, okay, okay. Repayment debt, payment of dividends, purchasing own equity, okay, or equity repurchase or repurchasing stocks like that. So obtaining loans, leasing, which is a financing activity. Leasing is an agreement between a company uh, so they can use a particular assets, okay, without taking ownership on that. So leasing, leasing, and convertible debt. And this leasing is something very, very important to understand the current state of world, because there's a few people that actually own things, and we are just getting this agreement, getting this leasing, by the way. So there is a huge people that live on leasing by that, okay? There is a huge amount of people that live on leasing by that. Mhm. Financial goods and market conditions. So once I look and once I understand at least the most common example of financing activities, okay, whether it's issuing equity, issuing debt, uh, repayment debt, asking loan or obtaining loans, payment of dividends, and leasing, very very important. Leasing, okay, there's exclusive or this agreement that a company issue on a particular property, plant, or equipment. So another company or another person can use that without taking ownership of that. Leasing, leasing, my friend. Interesting. Very, very. Very interesting. Leasing. Okay. Leasing. All right. Leasing. All right. So then I look at the footnotes here. Okay, so read the footnote because it's packed with information which, after all, this video is about of the read the footnotes. So the footnote of this financial statement come with some information important, some significant amount of accounting policy and practice. Meaning is that this company must disclose their accounting policy. So how they are conducting this accounting, if they stick to the GAAP or the EFRS, okay, so the generally accounting accepted principle on U.S. company, or the international financial reporting standard, where the whole goal of this is to make financial statements transparent, consistent, and easily shareable, and easily comparable around the world. So then I look at the income statement, which provides much more detail about the income taxes, whether it's from state, local, from federal, state, local, or foreign. Then the pension plan and other retirement programs, okay, like that. So pension plans and other retirement programs. So this section discusses what will be the pension plans or any other post-retirement program here. So they not contain specific information about the asset and cost of these programs, and indicate whether and by how much the plans are over or underfunded. And then I look at the stock option. Finally, okay. This is something very important to understand, because there is a huge there will become, or now it's already there. Okay, the pension plans and other retirement programs, for example, in places like Spain, France, U.S., Japan. So those pension programs in those first world countries, they're going to pass through a tremendous burden. And this is something important to recognize. Very important to recognize, because at the end of the day, the states are acting the same as corporations. They are acting the same as corporations, but unlike corporations, they don't have a print machine, a print money machine. You know what? They don't have that. They don't have that print machine, print money machine. Okay. And then let's look at the stock options. So I just want to know a little bit more about this. So what is stock options? Stock options. So stock options, according to Investopedia here, okay. So stock options is a financial instrument that gives the ownership the right to exactly. It's a financial instrument that gives the owner the right, but not the obligation, to purchase a given asset and an agreed upon price and date. So in other words, this stock options is an instrument. Okay, this stock option is a way for you to purchase a given asset at a particular date and an agreed upon price. Okay, so example of stock option. Let me ask here. Example or explain me stock options like a 11-year-old kid. You have a favorite toy and your friend really wants to play with, but you're not sure if you borrow. Oh my god. So imagine you have a favorite toy and your friend really wants to play with it, but you're not sure if you want to give it to them forever. So you make a deal. Okay. Imagine that you have a favorite toy and your friends really want to play with it, but you're not sure if you want to give it them forever. So you make a deal. You tell your friend, okay, you can borrow my toy for a week, and if you still want it, at the end of the week you can buy it from me from $10. Okay, so you can borrow my toy for a week, and if you still want it, at the end of the week you can buy it from me from $10. That kind of how stock options work. There are like a special kind of deal between two people, usually a company and employee. Mhm. Usually a company and employee, and the company say to the employee, "Hey, we'll let you buy some of our company stock in the future. Okay, hey, we'll let you buy some of our company stock in the future, but not right now, and we'll decide the price you have to pay for the stock later." So the employee get options to buy a company stock at a certain price in the future, but they don't have to buy it if they don't want to, of course. It is like having to choose the buy the toy after a week or not. Now let's say the employee thinks the company is doing really well and the stock price will go up. They believe the toy will become more valuable, so when the time comes to buy the stock, they can get it at a lower price, and that's what then they can get a lower price than what it's worth is in the market. That's a good deal. But if the company is not doing well and the stock price goes down, the employee doesn't have to buy the stock. It is like saying, I don't want to buy the toy anymore because I can get it for cheap. I can get it for cheaper elsewhere. Stock options are a way for company to reward the employee and give them a chance to share in the company's success. It's like saying, hey, we value hard work, and if our company does well, we have a chance to benefit from it. We have a chance to benefit, or you have a chance to benefit from it. I hope that helped you understand stock options a bit better. Let me know if you have any more questions. So, these stock options, now a more formal definition, okay? So, stock options are financial instruments that allow the owner the right but not the obligation to purchase a given asset at, at an agreed upon price and date. Okay. So stock options, also known as equity options. Okay. Stock options, equity options, where now this has a lot of sense. Uh, Stock options are equity options and equity derivatives. Okay. So give an investor the right but not the obligation to buy or sell a stock. Give the investor the right but not the obligation to buy or sell a stock at an agreed upon price and date. There are two types of options. Puts, which is bet that stock will fall, or calls, which is bet that stock will rise. Very, very important. Puts and calls, which is a bet that stock will fall, or call, which is a bet that stock will rise. Because it has share of stocks or a stock index and it is underlying asset, stock options are a form of equity derivative and may be called equity options. Employee stock options are a type of equity compensation given by the company to some employees or executives that effectively amount to call options. These differ from listed equity options on stock that trade in the market, as they are restricted to a particular corporation issuing them to their own employees. Understanding stock options. Options are a type of financial instrument known as derivatives. This means their worth is based on the derivative value, the value of an underlying security or asset. In the case of stock options, that asset is a share of the company's stock. The option is a contract that creates an agreement between two parties to have the option to sell or buy the stocks at some point in the future at a specified price. The price is known as the strike price or exercise price. Stock options comes in two basic forms: call options and put options. So call options is if the holders so call options offers the holder the right but not the obligation to buy the asset at a stated price within a specific time frame. And put options offer the holders the right but not the obligation to sell the asset at a started price within a specific time frame. Therefore, if X, Y, and Z stock is trading at 100 and 120 strike call will become a 120 strike call will become will become worthwhile to exercise. It is converted into shares at the strike price only if the market price rises above 120 or convert into shares at a strike price exactly only if the market price rises above 120 or $80 strike put will be worthwhile if the shares drop below $80 exactly. Okay, 100 strike call to buy an 80 strike put if the share drop below that. At that point, both options will be said to be in the money, meaning that they have some intrinsic value, namely the difference between the strike price and otherwise the options are out of the money. Expiration date, strike price, contract size, premium is the price paid for an option. It is determined by taking the price of a call and multiplying it by number of contract bought, multiplying it by 100. In our example, if a trader buy 5 January IBM, $100 call for 1% contract, the trader will spend $500. However, if a trader wants to bet the stock will fall, they will fall. So if a trader wants to bet the stock fall, they will buy the put. Important, the volatility of the underlying security is a key concept. So call price and strike price, input, interest, employee stock options, how to calculate the value of your stock options, how to exercise your stock options, exercise and sell to cover, stock options and taxes. If you exercise your stock options, you will need to pay taxes on any profit that you make. How your taxes are calculated depending on the type of option you have and how long you wait between exercising your option and selling your shares. So in other words, so that'll be all for this video. Take care. Bye bye.